Developed economies are hitting the brakes, China isn't quite taking off, and central banks, well, they've decided to take action. They're going to lower interest rates to try to ensure that economies have a soft landing or even to help them take off again with more energy. That's why on this channel, we've asked ourselves a crucial question: what could all this movement mean for the stock markets? Pay close attention to everything we're about to discuss. In 2022, central banks started raising interest rates and they didn't hold back. The US Federal Reserve, for example, implemented one of the fastest rate hikes in recent decades, and the European Central Bank didn't lag behind, bringing European interest rates to their highest levels since the early 2000s. It was done quickly, decisively, and without hesitation. The goal was to defeat inflation at all costs to avoid the specter of stagflation, which happens when inflation becomes chronic and economies stop growing. So, to avoid this, they raised rates, tightened monetary policy, and it worked. They controlled inflation without triggering an economic earthquake. In fact, most developed economies continue to grow, and in the stock market, well, let's say that investors have little to complain about. Since the Federal Reserve began raising rates, the S&P 500 has gained more than 30% in just over 2 years, and the Euro Stoxx 600 hasn't done too badly either, with a rise of around 28% since the change in monetary policy. However, in this case, the period is shorter, because the European Central Bank started raising rates later, in July 2022. So, as you can see, despite the rate hikes, stock market returns have been above their historical average, not bad at all. But of course, time has passed, and the post-COVID economic boost has been cooling off. Now central banks are changing course. Everything indicates that, over the coming quarters, there will be a gradual decrease in rates. They've already started doing this. Hello to all the community of Finance for All, welcome to another video. The question is, how far will they go? We don't know for sure, but it's very likely that rates will end up settling at an intermediate level, neither as low as in the last decade nor as high as in recent months. Of course, this will mean that we'll see cheaper mortgages, commercial loans, and all kinds of financing products. And that's why the big question is, what's next? What could these changes mean for the economy and the markets? Pay close attention, because these are two of the most important questions we face at this time. For many, the answer seems clear: the moment Jerome Powell and Christine Lagarde fully confirm the end of the high-rate era, the markets will start to take off. Think about it: once central banks lower rates, the cost of financing for families, governments, and businesses will decrease, and at the same time, if all goes well, money will start to leave money market funds and fixed income to return to equities. This, logically, is good for stocks. Moreover, consumers, thanks to cheaper financing, will also be able to spend more, which will boost corporate profits and increase demand. This, in turn, will lead companies to ramp up production and hire more workers. Then, job creation will allow more people to spend more, reinforcing the previous effect. Of course, companies will also pay less for their debt, which by itself will further raise profits and encourage them to take on more projects and make more investments. Finally, and above all, what matters most to many is that the rate cuts could reduce the risk of a recession. As you can see, all the pieces seem to fit: more jobs, more spending, more growth, a virtuous cycle. That's precisely why rate cuts are believed to stimulate the economy. And of course, if the economy is stimulated, growth goes up, and so do corporate profits. The process in this case would go like this: profits go up, stocks respond by rising, and the returns on equities cause a lot of money to flow from fixed income products, which are seeing their returns decrease, into this other market. Of course, this increases demand, which in turn drives stock prices even higher. Stocks could even rise more than corporate profits themselves, meaning that the market multiples could increase. And you know what? If we take a look at the S&P 500's P/E ratio chart, which tells us what investors are willing to pay for each dollar of annual profit, we can generally see that this is the case. The P/E ratio of the US stock market tends to move inversely to the 10-year Treasury bonds, which are largely influenced by interest rates. Now then, are we already euphoric? Is everything settled? Well, I'm sorry to say it, but getting to this point is only telling half the story, among other things because, of course, reality is a bit more complex. Rate cuts are not always a panacea. All those effects we discussed are possible, but not guaranteed, and, of course, there are also downsides. Would you like some examples? We have inflation, currency depreciation, economic overheating, bubbles, or the loss of income for savers, among many other possibilities. And certainly, it's not good to disincentivize the ability to create solid, well-capitalized economic foundations in our economies and businesses. But of course, these are risks that need time with low rates to potentially turn into real problems. That's why, today, they are not among the main concerns of practically anyone. So, friends, I want to repeat the key question we asked at the beginning of this video: what impact will the rate cut have on the stock markets? Can we expect the markets to rise due to this change just as we suggested a moment ago? Well, obviously, we don't have a crystal ball, but what we can do is look at and analyze what has happened in the past, which is exactly what empirical evidence tells us. To see what usually happens, let's look at the Federal Reserve's interest rate cuts over the past few decades and analyze what happened afterward with the US stock market. We're going to do this exercise for the United States, mainly because American stock markets provide us with more information and because, as we've said many times, due to their size, they are absolutely crucial for global markets. Well, since the early 1980s, the Federal Reserve has carried out 8 rate-cutting processes, in which it has implemented multiple cuts, as seems likely to happen in the coming quarters. Thus, if we take a look at what happened with the S&P 500 when the rate cut was announced, we can see how, so far, the markets have risen on average by 1.6% in just one trading day. But, of course, the day of the announcement isn't everything. To understand the real effect of rate cuts, we need to do the same exercise for longer periods, like a month, a quarter, or a year, depending on how long it takes to complete the rate-cutting process. And what are the results? Well, let's see. In general, the results are less exciting. We still see a positive return, but much smaller, between 7% and 10% annualized, which, by the way, is not far from the average annual return of the stock market. And that's if we're talking about the S&P 500, because if we look at the Russell 2000, which includes smaller companies, the result is much more modest, with a return between 2.4% and 5.4%. Why does this happen? Well, basically for 3 reasons. First, because stock markets tend to anticipate and price in these events. That is, when the rate cut happens, stock prices have already adjusted. Second, because the effects of lower interest rates on economies take time to appear. We often forget this, but the consequences are not immediate. Third, because what really matters in the medium and long term in the stock markets are 2 things: the structural health of economies and how robust the business models of the listed companies are, meaning their competitiveness. Yes, as we've explained, rate changes have effects, but these effects can fade much faster than we might think. Also, there's a very important detail we cannot overlook. Rate cuts usually occur when the economy is slowing down or nearing a crisis, which of course negatively impacts everything: corporate earnings, future expectations, and investor sentiment. It's precisely because things aren't going so well that central banks cut rates. From that perspective, rate cuts can help slow down the deceleration, but with a weak economy, corporate earnings are unlikely to be booming. So, does this mean that the current rate cut won't help the markets and that it's not a good time to invest in equities? Well, friends, we haven't said anything of the sort. Despite everything, we've already seen it. The evidence shows that, on average, rate cuts have a positive impact on the markets, which in itself can be a reassuring factor. Obviously, no one can guarantee that the future will be the same, but at least having the support of past experience is helpful. And most importantly, the health of Western economies at the moment seems reasonably good. The fact is, if the rate cut facilitates a soft landing for the US economy and marks the beginning of a new cycle, that could be great news for equities. Because, friends, there's something else we've deliberately kept from you until now. Do you remember the 8 historical rate cut processes we mentioned earlier? Well, so far, we've only talked about the average annualized return that the stock market achieved after those cuts. However, the truth is that the data is tremendously variable. It ranges from a return of over 20% in 1998 to a nearly 20% drop in 2007, when the great housing and financial crisis was about to explode. And what did this highly variable outcome depend on? Well, basically on how good or bad the economy actually was. The reason behind the rate cut can be even more important for the stock markets than the cut itself. In fact, some research also points out that stocks tend to rise in the period of 6 to 12 months after the first cut, as long as the economy avoids a recession. And as I say, the good news now is that the US economy seems very strong. That could really be the best news. Of course, the effects won't be the same for all sectors and companies. There will be businesses that benefit much more than others, and that's where we need to pay close attention. So there you have it, that's what we can expect with the rate cut. What we do know is what the evidence tells us: if rates are cut and a recession is avoided, the markets could perform very well. The question now is, will they? How optimistic are you? Leave your thoughts in the comments and let's open up the debate. And if you found this video interesting, don't forget to give it a like and subscribe if you haven't already. Thank you for being here and see you soon.